please go ahead.
Great. Well, thank you, Annette, and thank you for inviting me. And so this is not a paper; it'll be a set of slides. And what I'm going to do, there's a lot of sort of disinformation or misinformation out there about private equity and private capital. And so I'm just going to go through what private equity and private capital have done in terms of growing over time. Then I'm going to tell you what it does at the company level, and focusing particularly on buyouts, which are really it's the asset class, it's the biggest and gets the most attention. Then I'll tell you what it does at the fund level, and then I'll sort of talk a little bit about the future. I have a book with Paul Gompers, so I'm pitching my book that has some of this in there, but it's even that's a little dated because the data change. So that's what I'm going to do. So here goes. This just shows you. Oh, I forgot to do that. Okay, good. So that just shows you over time global AUM in private capital, and then this now includes venture, real estate, growth, and others. But you can see buyout has grown and private capital has grown by a factor of 3.5 times, which is quite substantial. This is a picture again of how it's grown. This is, I think, from this BlackRock or it's Preqin, and just their expectation it's going to continue to grow. So this is not not finished yet, at least according to some folks. This just gives you a sense of where the market is and how it's divided. This is a couple years old now, but buyout is the black. Buyout is about half. Sorry, North America is the black, and North America is about half. Buyout is over here, and buyout is kind of half North America, half elsewhere. Europe has a big chunk, and that's about 3 trillion at this point. Then you got venture, big chunk, US and Asia, and then these other classes, growth, private debt, et cetera. But just shows you North America is a big chunk of it, but it's pretty much, it's a global phenomenon. Now I'm just going to look at buyout. This is buyout in the US. This also shows you how it's grown. It was tiny in the 80s, went up a lot right before the financial crisis, went down, and then went up. And what this is this is commitments each year. So this is not necessarily money that's put to work. This is what the pension funds, insurance companies, endowments, whatever, are committing each year. And then they have 5 years in which to invest it. And this is nominal. So now let's look at what I think is a better measure, which is as a fraction of the total value of the stock market. So this is the US buyout commitments to the US stock market. And what you can see actually here, again, you see the pattern is straight up. It went from about, I'd say, 0.4% of the market each year to 0.8%. It's actually been stable over the last 10 years in terms of how much is committed to buyout funds. But I want to give you a sense, back of the envelope calculation about what this means. So over a 5-year period, which is the period in which the money's invested, so that sort of gets you a sense of stock, that would be about 4% of the stock market is in private equity. And when they invest, they're pretty much leveraging it 50% debt, 50% equity. So that would get you 8% of the value of the stock market. There's also money that goes in that's not in the funds, which is probably around another quarter. So you basically have about 10% of the stock market is in buyout funds. And so I don't know if 10% of the papers you see are about buyouts, but it's 10% of the economy estimated that way. And, if you put in venture capital and growth equity and infrastructure, you would, I probably get to 20% of the economy. So this is something where, it's at 10 to 20% of the economy we're talking about, and it doesn't get 10 to 20% of the play, at least in this room. But you should just know it's actually meaningful. Okay, so what do buyouts do at the company level? And this is where, if you read the business press, this is what you see. There was, a book about these are the plunderers, actually 2 books with plunder. John Coates had a book, The Problem of 12, where he was saying they don't do good things. And the truth is, at the company level, basically every large sample study that gets refereed and published finds an increase in productivity or profitability. Shouldn't say every, they almost all. And there's not one that actually finds a decrease in probability or in profitability or productivity. So the best paper is probably, or papers, are the papers by Steve Davis, Josh Lerner, John Haltewanger. They look at a large fraction of buyouts in the US, and they basically find a significant increase in productivity, both for private to private deals and public to private deals. There are other papers, that more or less find the same thing. And, there's some evidence public to privates. There are a couple papers that find mixed results, or they don't find positive, they don't find negative. Employment, so there's sort of, you get a view that buyouts just fire people and they gut companies. And what the Davis paper finds, that in existing operations relative to firms in the same industry, employment grows by somewhat less. When you include new operations, it's insignificantly lower. And it masks something in private to private deals where a buyout firm is buying a private company, employment growth is much higher. And in the public to private deals, that's where employment growth is lower. And the thing on the public to private deals that's worth thinking about, those are in some sense acquisitions. And if you compared the employment growth to what happens in an acquisition, my guess is the employment growth would actually be higher, because in a lot of acquisitions, you see a lot of job loss. So, the bottom line, there's not a significant difference in average compensation per employee. And finally, none of these papers measures what happens outside the US, so they're a little bit blind to whether things are moving to the US in a differential way. But the bottom line is there's, some slight decline in employment growth versus other companies, but it's not huge, and it's not, this view, again, that you get from these books and articles that they're just going out and plundering. So there we go. Now, there are a bunch of papers that look at non-financial results, and these are largely positive. Bloom et al. Found that private equity-backed firms have better management practices. There's a paper found that PE firms increase sales with new products, not price increases. There's a paper that finds that private equity investments in airports bring marked improvements. Your planes aren't late, your facilities are better, and so on and so forth. But a lot of papers that find positive results, they tend not to get as much attention as the papers that get negative results. And so, there's a paper, Constantine's here, private equity firms actually make more money with for-profit education, but the students default a lot. So that seems like a bad thing. There's also a paper that they, Constantine and Sabrina wrote, find that PE-backed nursing homes have worse health outcomes. That gets a lot of attention. And in both those papers, they say, well, there are private incentives to increase profits, but you have bad outcomes. And in the nursing home paper, that actually doesn't work because the deals lost money. So they were probably mistakes. And so that conclusion is probably harder to justify. There's another paper actually finds COVID deaths at PE-backed nursing homes were lower. And so, a couple other papers that find, negative results, but and that's, what you would expect. Lots of positive, some negative, and overall, the private equity portfolio companies are more profitable and more productive. Now, I'll give you another example, just so you get a sense of what the press does. And when you read these kind of articles, there was a paper in JAMA that said changes in hospital adverse events and patient outcomes associated with private equity acquisition. And what they find is after the private equity acquisition, Medicare beneficiaries admitted to private equity hospitals experienced a 25% increase in hospital-acquired conditions. So that sounds bad, but in-house mortality actually declined. Okay, so that's good. That's probably what you care about more. What got reported? Private equity ownership made care riskier for patients, takeovers tied to increase in falls. So it was all negative rather than positive. Now, what's interesting is you actually go look at the data, and it's actually kind of neither of those. These are, the red is, sorry, orange is private equity hospitals, the blue is controls. They look kind of the same in year -3. They look kind of the same in 0, 1, 2, 3. They're like identical. The only place they're different is actually year -2 and -1, where the private equity hospitals are better. So what's happened is that the private equity hospitals in year -1 to 0 have gone from sort of where they were in -1 and back to where they were in year 3, but they're no more, in terms of falls, they're actually no different. And what's sort of weird about this result is pretty much the big flip is in year 0. And of course, year 0 is the year the deal happened. So in half of those deals, the deal didn't happen until like after July. It's impossible that they could have made changes to these companies so quickly and just all of a sudden said, oh, don't treat the patients. It takes time to put these things in. So it's another way of saying this paper is almost surely spurious. Yet what gets reported is very negative. So just beware. So the bottom line is the evidence across a lot of large samples is that private equity investors make their companies more efficient and productive, usually with positive externalities, and that success attracts critics. So that's at the company level. Where does the value come from? The value comes from, we think 3 places: financial engineering, governance engineering, and operational engineering. And I'm going to talk about all 3. So this is a basic, question. Where does we think they're increasing value? Where does that come from? Financial engineering, they still, KKR did this back when LBOs first came into existence in the 80s. They still do this. They give more equity to management than they would have certainly in a public company, certainly in a division, and oftentimes in private companies. And they put debt on the company that gives you some pressure to generate cash flow. Governance engineering, the private equity investors they control the boards of their companies. They're very involved in monitoring. And the third piece that has actually come into existence in the last 10 to 20 years is most of these buyout firms have operational engineering or operating capabilities. So they're organized around industries. They didn't used to be. That industry expertise helps them find deals. It helps them identify improvements, and it helps them actually drive change. And when they invest, they have an idea of how they're going to increase value at the time they invest. And I'll talk more about that as we go along. So let me sort of summarize some results from 2 surveys that I did with Paul Gompers and Vladimir Makarliamov, where we surveyed roughly half of the buyout funds in terms of AUM who were operating at the time. And first thing we asked them is, how do they make investment decisions? And the three most important things were the business model, the management team, and their ability to add value. So this point that they're thinking about adding value to the company when they invest is definitely there. And this was a survey in 2020. We then asked them where they expected to get that value from. And by a very wide margin, they're looking at growing revenue of the business. So this view that they go in and they're looking to gut the company, reduce costs, they do that, that's second, but it's way behind their intention to grow the business. And leverage is fourth. And why does that make sense? Well, you have to sell the business, and the best way to sell a business is if you grow it rather than if you gut it. Previous survey, we asked them sort of the same question in more detail. Where do you think the value comes from? And increased revenue was number one. Improved incentives was number two. We asked them, how often do you work with your companies? This was in the middle of the pandemic. It was something like 82% of them said they were interacting with each of their companies once a week or more often, which is a lot more than you would have seen from public company board members. And it's actually more than you see from the venture capital firms. And I was the judge for something called the PEI Operational Engineering Awards, where companies, it's basically a deal of the year kind of award. And so this is selected, this is positively selected. These are the deals that went well. But when you look at the deals that go well, what do? New CEO, upgraded team, new strategy, technology upgrade, new sales approach, new products. All of those are kind of about growth. Improved efficiency would be cost cutting. So again, this is just a way of showing you they're not gutting companies. They're actually growing the businesses and working to make them better. And if you look, again, popular press, you will see many of the same examples of failed deals, and you see them again and again and again. You rarely see positive deals. Positive deals do exist, and there are a couple, Aldevron here and Marave, which were both private equity purchases. And in both of those cases, these were suppliers to the mRNA manufacturers. These are very profitable deals, but what these deals did, they actually helped, turn out the COVID vaccine. And, I don't know that I've ever seen any articles about those two. Apollo bought an airline in 2018, and you would have thought that airline would have failed given the pandemic. Turned out to have done very well because they transformed the business into a tech-forward, low-cost carrier. They actually put in a lot of investment, and it generated a lot of improvements. And I can give you other examples of that. TaylorMade Golf, for those of you who are golfers, went from negative 80 million of EBITDA to a positive 192. Company invested a lot into TaylorMade Golf. KKR has some examples where they actually share ownership a little more broadly with their employees, and that has led to a number of successful outcomes. So I'm just going to stop there. Just bottom line, the large sample evidence shows that buyout investors improve the operating performance and productivity of their portfolio companies. They're focused on growing their businesses because that's the better way to make money. And again, you would not get this from reading the popular press or listening to politicians. And so this talk is a little biased in that regard, maybe, but it's worth doing because there's so much negative bias out there. There's actually this isn't terribly biased except on the operational engineering awards. So that is at the company level. And now you probably care more about the portfolio level, which is where investing is. And so what I've showed you is that the performance goes up at these companies. And so you ought to beat, sort of have abnormal performance gross of fees. The question is what happens net of fees. And this depends on what the private equity funds pay to acquire companies, because you may have to pay a premium, and it depends on fees, and the fees are non-trivial. So let's see what we know about performance for LPs. So this is performance net of fees. And the data I'm going to talk about is Burgess. And Burgess is, we think, the best data for performance. It doesn't have a reporting bias because they get their data from limited partners rather than from the general partners. So the data aren't, there's no reporting bias. The GPs or the private equity investors have to report to the limited partners. The good news on this too is that there's a very different database that also doesn't have a reporting bias called Adipar. Ralph and Chevier and others have worked with it, and the results are basically the same. So these results we think are pretty good. So what's very interesting is the industry is in some sense very unsophisticated, certainly relative to public markets, certainly relative to the people in this room. A lot of people just look at annualized IRR net of fees, and that's crazy because that's an absolute measure. And multiple of invested capital, which is just, value returned divided by value invested, which is also an absolute, not a relative measure. And so you'll see these are the returns. So what each dot here, black is average, red is median. This is for buyout funds in the US. And I showed you that's a big chunk of the market. These are the most recent measures. So this is as of September 2023, and they sort of get reported with a lag. And each dot or square, well, triangle or square, looks at all the funds raised in a particular year. So these things up here, would be the average and median fund raised in 2011 has, over the course of that fund's life, which is now 12 years, has an internal rate of return of about 17%. So that's what that's telling you. And you can see it's, some years it was 5% annualized return, and some years 20. So it varies quite a bit. Again, you don't know what this means because this is absolute rather than relative. This is cash on cash. So this is your multiple of invested capital. These are a lot more stable. It's like 1.5 to 2 times your money. So over the life of the fund, that's what you're getting in different vintage years. And so you're not getting rich making 10 times your money, but you'll notice those are all positive. And again, compared to what, you don't quite know. And so vintage year IRRs vary a lot. Vintage year multiples vary less, but they vary. And is that performance good or bad? Antoinette Shore and I wrote a paper 20 years ago where we said, you might want to look at this relative to just something simple like the S&P 500. So what this basically does is it takes the cash flows of the company, it's sort of an apples to apples comparison of when a dollar goes into private equity versus you basically put a dollar in the S&P 500, and you can actually either go till the end of the fund, in which case you're growing everything at the S&P 500, or you can look at it, bringing it back to the start of the fund where you're basically discounting at the S&P 500. And so basically what this is doing is just saying what happened to your private equity investment compared to investing in the S&P 500. And very simply, if this is greater than one, you did better than the S&P 500. If it's less than one, you did worse. And I'll just, get a sense for funds after the great financial crisis, 2009 to 2020, how'd they do relative to the S&P 500? So how many of you think they did better? How many think, oh, wow, very interesting. How many of you thought they were equal? And how do you think they did worse? Okay, so you all think they did better. This is the look for every vintage year, and I'll take the black. The black is a pooled average, which is closer to a value-weighted average. Each of those dots is a vintage year. And what is remarkable, and again, you wouldn't necessarily know this if you read the business press, every single year since 1992, and certainly after 2009, private equity portfolio has beaten the S&P 500. This is net of fees. Every year. Beta of 1. So it's S&P 500 and no liquidity. If you want liquidity, and but this is, and liquidity, liquidity is a religious discussion, which maybe Anna will have. But this is unbelievable. This, and you talk about risk. Where's the risk there? Right? They're all greater than 1. It shouldn't happen. This is, and it's unlikely to happen going forward. But if you want to sort of understand why money has gone into private equity and buyouts in particular, why institutional investors have gone there, that graph is your answer, I think. And this just annualizes it. If you annualize the returns there, it works out to about 5% a year over the S&P 500. And this is relative to the Russell 2000. It's actually higher, particularly post-GFC, relative to the Russell 2000, which maybe is a better benchmark because these are not large cap companies, they're mid cap companies. But it's, the pattern is pretty similar. Now your question about leverage, Raj, is, there are a couple of papers, Korteweg and Nagel recently, Greg Brown, and others, where they looked at the cash flows of the funds and they used the Burgess data. And over this time period, they actually found a beta of 1. So if you wanted to adjust for beta, it's pretty close to 1. So those would be legitimate alphas if you believe those papers. And Ravi Jagannathan tells me that if you have an Epstein-Zinn utility function, this works. This is fine to use as well, whether there's a beta of 1 or not. So now some people are concerned that the valuations are overstated, particularly the more recent funds. And this gives you just a view of how these valuations move. Because the funds are not fully realized, the valuations could move, particularly the more recent vintages. And what you see here is vintages that are 2014 or earlier have been pretty stable over time. The black is where this PME is today. The green is where it was a year ago. and the purple is where it was in 2019. And you can see the more realized stuff doesn't move very much, unlikely to move. These could move, but it's highly unlikely to go below 1, given that these are now, these are, 7, 8 years old. I did ask a number of buyout investors whether those NAVs were overstated, so whether you expect them to come down. And this was about 20 or 30 of them, and they said their own funds were not overstated largely. They did say other funds were overstated, and what's interesting is, like, these are buyout funds. The venture funds are definitely overstated, so you have to be careful on the venture funds. So these may come down, but they have to come down a long way to not be greater than 1. Okay, there's Ludo Philippou is, sort of gotten a lot of attention because he says that private equity doesn't beat public markets. And I just showed you buyouts definitely do beat public markets. How can Ludo say what he's saying, and how can I say what I'm saying? Who's right? And you know who's right, but let me explain why. And then there's actually an article in the Financial Times just last month where he was citing Ludo, and he was citing some other stuff and saying, they don't beat public markets. So again, it's like, it's just sort of crazy. So let me just show you where some of this comes from. Ludo, when he did this, actually didn't just have buyout funds, venture capital, growth equity, which are equity. He stuck in natural resources, real estate, real assets, infrastructure. It's not clear those ought to be compared to the S&P. And so when he did this first in December 2019, if you actually compared what I think is true private equity, buyout, venture, and growth to the S&P, it beat the S&P by 7%. Cumulatively, that's about 2% a year. And if you do that today, it's 1.1. It's by 2% a year. So and I should also mention, he's using vintage years from 2006 to 2015 when he did this. So he picked particular vintage years. So the first thing is he's kind of comparing apples to oranges, where he's got things that I don't think have equity risk, and he's giving them equity risk. So that's one. And it's funny because he wrote a paper in 2012 saying you should use the right benchmark, and he doesn't. So, then, the other thing I should add, which is interesting, he has a paper coming out in the Journal of Finance where he has to estimate, as part of their simulation, alpha for private equity, and he puts in an alpha of 3.5%. So it's very funny that he says there's no alpha, but then he puts it in his paper. So that's one. Just think of this as the wrong benchmark. So the time period he used was 2006 to 2015, and that's not a natural choice. You would think, why don't we use everything after 2000 or everything after the GFC? And it turns out that choice of vintages overweights 2006 to 2008, which was the worst performance of private equity. And so if you use any other period, the results are higher. So I told you it was 1.05 when you use the right set of data. That was 2006 to 15. If you use 2000 to 2015, it goes up. If you use 2000 to 2019, it goes up. 2009 to 2015, it goes up. So that's just a way of showing you he picked the worst set of vintages. And actually, if you look at the numbers today for those vintages over time, this is where I think I told you, private equity has outperformed by 4 to 5% a year over all of these time periods. Even if you use the wrong assets, so you put in the things that you shouldn't put in, and you use the vintages that are, probably more natural, you get outperformance relative to the S&P 500. So the benchmark matters and the cherry picking, the time period matters a lot. I already said the Russell versus S&P. So bottom line, he's confused and or misleading. And so that is something that is worth knowing. It also contradicts his other work. So I will leave it there, but he sort of sows a lot of confusion out there. And it is confusion that's really just bad. And again, this is all looking backward. So I'm not making any predictions about future performance. But when you look backward, it's very good. So now another thing that's interesting that I did with Bob Harris, Tim Jenkinson, and Rudy Stuckey, we looked at persistence. So this is the idea: are there good GPs, and do the good GPs repeat? So this is asking, can you pick buyout funds that are going to outperform? And we did this. This is as of December 2020. So it's not the most up to date when we did it, but it's pretty up to date. So if you could pick, there's actually a fair amount of variation from the top quartile to the bottom quartile, and that's just showing that PMEs by quartile. So the top quartile cutoff is about 1.4 times the S&P 500, and the bottom quartile cutoff is less than 1. So if you could pick funds that are going to be in the top quartile, you do great. If you can't pick, you do horribly. And this is just a view, and post 2000, it's probably the better place to look. Top quartile funds, if you could pick, have an average PME of 1.7, and bottom quartile funds 0.71. So now the question is, can you predict? And so here's what we do. We look at where the funds were at the time of fundraising. And so what the column is we look at the fund you raised before and what quartile of performance that fund is in when you were fundraising. So let's say KKR raised Fund 4. We're looking at where Fund 3 is when they raised the fund and where that fund is relative to other funds that were raised that year. So, and this works. You can use other measures of past performance. And then the current fund quartile is where the fund that they're raising, Fund 4, is at the time we wrote the paper. And what you can see in the 3 columns on the right are that the previous fund performance tells you nothing. So previous fund performance, and a lot of investors say, or they used to say, we're going to get into the best funds because they persist. And it turns out in buyout, you have, basically no persistence that you can use at the time of fundraising. Venture, it turns out there is persistence. So for venture capital, the result is different, but for buyout, no persistence. And you could go to the second previous fund. So this is the fund, basically you'd be looking at Fund 2 when they're raising Fund 4. And again, there's no pattern there, no predictability. So my private equity investor friends don't like this result because they all think they're good. But it's very hard to get persistence. Niels? This is all net of fees. In buyout, it's the fees are pretty much 2 and 20. There are very few that have premium carry. In venture, there's much more premium carry and there's more persistence. So it's actually, it's a little surprising. they grow the size. The best, they grow the size. That's how they make money. And they grow the size more in buyout than they do in venture. And size hurts a little bit, but doesn't hurt very much. It turns out, actually, if you knew what the performance was of the previous fund at the end of the fund, you'd actually have some predictability. So it turns out that, but unfortunately, you don't know that at the time. The other thing that's very interesting, let me go back to this, is if you look at the number of funds, they're basically, nobody raises a fund when they're in the bottom quartile. So when your previous fund is performing poorly, you don't raise a fund. The only people who raise funds, or the people who tend to raise funds, they're doing well. You see they're in the top quartile or the second quartile. And then at the end of the fund, that's also the case. What you are getting in this business, people who perform badly end up going out of business. So there's rationing is a bit more on quantity than on price, going to the two comments there, which is interesting. There we go. So summary at the fund level, buyout fund performance has been remarkably good. And outperformance has been roughly 5% a year over a long period of time and post great financial crisis. And a lot of that value has gone to pension funds. It doesn't seem to be leverage or risk to the extent the fund betas appear to be about 1, and there's not a lot of usable persistence. Caveat, doesn't include VC, real estate, or infrastructure funds, and they have different patterns. Why has this grown so much? I think people chase performance. That performance has been good. There's some evidence that provides diversification. So the public markets are tech heavy. The buyout funds, even the cash flows, give you some diversification over public markets. Regulation, I think it's gotten to the point where being a public company is less attractive than it used to be, and being a private company is relatively more attractive. And there's some evidence to that extent in a couple of papers. And it's also, I think, the case if you talk to executives about whether they'd rather run a public company or a private company, they're attracted to the private companies. They get paid more. I've got a paper that shows that. And at least anecdotally, they have less brain damage to deal with on the regulatory side, and they get some help from the private equity investors. So that's on the buyout side. Private debt, same thing. Regulation has led, and I don't know if that would have been in Wenshin's paper. The insurance companies are investors in private debt, but you've also seen a move from lending from banks to private debt investors, and that's also, I think, driven by regulation. The future, what will happen? I think you'll see that performance advantage versus the S&P in the most recent vintages. I'm not sure that will continue because the S&P has done really well, and the higher interest rates have hurt the more recent deals. So that record may go away. And that's just that picture again. New deals, at some point you would think competition should drive away excess returns. If you believe there should be an illiquidity premium, maybe not, although these deals are less, the funds are less illiquid now because there's a secondary market. On the other hand, the private equity firms are still looking for very high returns, and they're still, they're very, very smart at what they do. So it'll be very interesting to see how that plays out. There are other tailwinds. Operational engineering is real. CEOs like to work for private equity funds rather than being public. Regulation is less onerous. Same thing for private debt in terms of regulations. The negatives, there's a lot of money there. Interest rates are still high. You get a lot of negativity from the press, and that generates regulatory risk. And I think you could very well see more regulations on the private side, particularly if the 2024 election goes in one direction. So who will win? You know, if you do, it's really a question of how you do relative to public markets. And firms that beat public markets will do well. And if they don't, they won't. The regulations are painful for all the players. They actually benefit the big players. So if you get more regulation, it's good for Blackstone and KKR. And it's also good for family offices. There's a lot of money in family offices, which again is data that I think will, there'll be more interest in that over time. So bottom line, at the company level, private equity outperforms. At the fund level, they've outperformed. It's grown because of the performance and because the private equity firms have actually basically gotten smarter. Going forward, I think the same factors are still in play. So private equity is not going to go away. Private capital is not going to go away, with the caveat there is regulatory risk. And I will stop there, and we're good for questions. So thank you.
Mike Weisbach and co-authors have a JF that argues that the beta is like 1.8, and the alpha, I think, is like statistically insignificant. This is like...
They have a weird data set that is secondaries, and secondaries a very selected sample.
Yeah, but
and
I think the estimator is a selected sample. I'm not on this paper.
No, they tried that paper. I would just push you to the Greg Brown paper and the Korteweg and Nagel paper, which look at a very large sample. They're looking at deals that had secondary transactions, and that's a particularly selected sample. So I don't find that very persuasive. Also, I mean, again, I would also show you this picture. This is like a really interesting picture here. You would have thought, you know, if the beta was 1.8, you know, how do you explain, you know, this 06 to 08 deals that should be way below 1, right? Because we know what the market did then. And that's, you know, you'd get the same thing actually around 98, right? The stock, these deals, they did it and the stock market went down, right? Beta of 1.8, how should those deals have done? Those vintages should have been awful. Look at what those vintages are relative to the S&P. So you just look at this time series and it looks a lot more like 1 than it does 1.8. So.
I have two topics I want to raise quickly. So one of them is just a matter of a theory, if you want. Imagine that you have a logarithmic investing world, and there are two assets. One of them is private equity, and the other one is the public stock market.
Mm-hmm.
You take these two returns, you divide one by the other, the expectation is going to be larger than 1. Either way you do it. And this is just because you can't have the wealth of the representative agent be given by one of the two assets. And to the extent that one asset is not quite 0, your private equity is 10, 20% even, one gets a bias. I'm not saying that it explains everything, but it's there. We calibrated with Stavros a simple model, and we get like 7-8% or something from that.
So and what happens if you do it the other way? You want to
both of them, both ways. It's a Jensen effect.
Oh, it's basically a Jensen effect,
and it's unavoidable as long as you see what I'm saying.
And they get the same result. So. And
I'm just saying that I'm talking about
the PME. So I would just say the GPME, you get the same result. Korteweg and Nagel, you get the same result. They have a different estimator than the GPME. And I have to think about that because, you know, I'm trying to think of the Jagannath and Sorensen paper, which said that this was perfectly okay. So I'll have to think about that. I hear what you're saying. I hear what you're saying.
So the other thing I wanted to say, that you didn't offer this response, and maybe you don't believe in it, maybe you just didn't want to spend time on it, on liquidity. Some people might think it's the other way around, that they prefer the option not to mark things to market too carefully, and therefore they may value something more illiquid in their portfolio.
So the value of illiquidity, again, all this is realized, pretty much everything pre-2013 is realized. So the pre-2013 stuff, there's no, assuming that's still positive, there's no like preference for liquidity there. I think your thing is saying like, even if the returns were equal to the S&P 500, you might like it because,
The other way around. I was trying to help you, if you wish.
no,
Saying-
why?
Saying that as an investor, I might
there's no
prefer.
liquidity. There's no, you're saying that we do it. I would invest in this even if the returns were the same as the S&P 500 is what you're saying.
That I like illiquidity because I don't have to report
No.
my assets.
Yeah, and again,
Besides-
I'm not here. I'm saying like, this is all reported. I'm assuming it's even up. This would give a reason why you might want it. I mean, there's another reason, which is related to that, but is a little different. Like in 2008, 2009, when the market tanked, what did a lot of people do with their equity portfolio? They sold it, their public equities, because they were scared. And so the fact that you were locked in was really a nice thing. And maybe it was smooth, maybe it wasn't. So, you can argue that there's, that the illiquidity premium should be zero or a discount, which is yours is another way of arguing that. And then Anna, who's arguing it's positive. And that's why I said it was a religious discussion earlier. Because I think you can argue it in any way.
Ourselves. This is not the behavioral.
I didn't say you.
Hi, so a very interesting and informative paper, but I still have a couple of questions on risk. So when you measure your beta, there's a lot of leverage in this thing. So what is the unlevered or the asset beta here? Which surprises me, if you're measuring the levered beta to be 1, then the asset beta with such high leverage should be very small. That means the class of assets that these guys are buying is very different than average corporate capital in the US. So that is one thing that intrigues me. On the non-serial correlation, I mean, we have the Burke and Green classic paper there, which would tell you that you don't expect it, because once people realize that they are good, they will automatically adjust these things in some ways. But the third thing is that there's a fairly well-known result in asset pricing is that alpha is expensive, beta is cheap. So if you change the benchmark, I mean, there is standard ways to convert beta into alpha by changing the benchmark, right? So you can take the 1-factor model, get an alpha, take the 3-factor model, get another alpha, take the 5-factor model, take another factor, choose your alpha for marketing purposes. And of course, there is a well-known result that if you look at Berkshire Hathaway, for instance, with a 3-factor model, there is no outperformance. There is zero alpha. If you look at with one factor, there is. So when you mention these results about alpha and things like that, I think telling us the benchmark and why you chose those benchmarks may be interesting.
No, very much. So the first thing, remind me of your first point again. Say that briefly. Was the asset beta? So the asset beta is that it's surprising. Again, this is in the Greg Brown paper and the Cordo-Agnago paper, where they're using the cash flows from the funds and from the same sample of funds, and they're getting it. Why that may be the case is the following. First of all, the leverage is 50%. It's not 80% like it was back in the 80s. So it's 50%. Public companies are maybe 10, 15%. So you've got a 35% leverage piece. What's going against that is, to the extent they're adding value, and again, I think the evidence is pretty good they add value, that's zero beta. They add value that, so you have the existing business, you add value to it, zero beta, and you put it together, maybe that offsets the 35%. I don't know, but it's plausible. And then the other thing that's going on is the carry, they're getting 20% of the profits. When do they get that? They get that when usually the exits are when the market is good. And so you're getting sort of taking some of that off. So that's going to reduce the beta of the assets. Yeah, so you have some offsetting things to the leverage to get that beta plausibly to 1. And again, you can't measure this exactly, but I would say those are why, you find it. And again, it's in those 2 papers, and it's in most of the papers that look at the betas of these portfolios. Persistence, yeah, I agree. Persistence should go away, the Burke Green thing. It doesn't in venture, which is a little bit surprising. It does seem to go away in buyout. And then the right benchmark, again, to the extent most of the papers that look at buyout funds, and again, the GPME, which was first quarter Wegnagel, then there's another quarter Wegnagel, they use different, benchmarks. They tend to find positive alpha over this time period. So.
Yep. You showed a couple of media reports and also books, and are these journals misinformed, or are they biased for some reason? And why is it so important to win the public opinion in this case? Like, and what is going on? Like, why do they choose to? Is it sensationalism?
That's a good question. I think the buyout investors make a lot of money, and I think that creates some skepticism. And I think when the deals go bad, they get a lot of attention, and that sort of creates this, momentum that they're bad, even though, and you tend not to see the ones that are good. It's a good question, and I don't know. I don't have a good answer for it other than what I
There are
just
other
said.
rich people, like Warren Buffett, for example, like never gets a bad reputation. Like, I mean, it seems like, this group of people seem to be like bad actors somehow. There is some resistance, but there are other rich people, like they have better publicity, I guess. So
Can you give us
Yeah.
an update on the taxation issues in the industry? In terms of
Was
the
that
bad
a
press?
question?
That was a question.
So
What
what's
is the
the-
latest on the tax
Oh,
situation?
the tax. So this is, and maybe this also, gets, negative, that the carried interest, that 20% of the profits that they get in their compensation is taxed as capital gains. And so, every so often Congress will say, gee, we should tax these things as ordinary income because they're income you're getting doing your job. And then they never change the tax law, but it's always a discussion. I think it's a way for politicians to raise money, I think, but
Would you be in favor of a tax change then to improve the press of the industry?
so that's actually complicated, and I'll tell you why. Because if you tax, and it's actually ambiguous, theoretically, whether it should be income or capital gains. And so you could go either way. I think the practical matter is, if you did it, the good funds would make the following adjustment: that if you are a buyout fund, when you do a deal, you're creating a new co. And when you create a new co, everything is new. And what I would do is I would fund the company 50% debt. I'd have 40 or 45% preferred, and I'd have 5 or 10% common, and I would take 20% of the common. I would get 20% of the upside, and I'd buy it as, part of, personally, and I don't net across other deals because that's how the carry works. It's netted, and I would get capital gains treatment because it's common stock, and the LPs would be disadvantaged because there would be no netting. And so you would actually be in a place where the GPs were kind of in the same place and the LPs are worse off. And that's what would happen. And what's interesting is the venture capitalists can't do that because they don't create new cos. They're investing in existing companies. So if you made that change, it would really hurt the venture capitalists, and at the end wouldn't hurt the buyout investors very much. So that's the unintended consequence. And whether you want to do it or not, I don't know.
Do you have data on the timing of these payouts? Because, I suppose that like a deal, if there are a lot of deals in 2006, probably they took much, much longer to close than a deal like in 2014. And then how to think about that? Should we?
Yeah, that's where, I mean, the PME is designed to capture that because you're capturing the, and I'm going back here for a reason.
But for thinking about the beta is complicated, right? Because, the stock market, of course, if you zoom in 2008, it crashed. But by 2012,
Over the whole period. I mean, that's, again, that's the PME where I'm using a beta of 1, right? You're just doing, there it's capturing what the market is moving. And you could put a beta on that if you wanted to. But you can tell they're doing something here because if you look at the IRRs of the deals, like the 98 vintages, they're low, whereas the MOIC is low, but not as low. So they're holding those longer. So there's clearly timing and that you tend to exit when the markets are better and you don't exit when the markets are lousy.
Last question. All right, thanks a lot, Steve. That was
Good.
great.
Thank you.